Hello friends, James Stevenson back with part 14 of my Tesla 2022 Q3 earnings forecast review video series. This is the exciting part that perhaps you've been waiting for. We've gone through a lot of the charts and visualizations that help to understand Tesla's success to this point, as well as my forecast for what's going to happen in future quarters. And then following that, in parts 10, 11, 12, and 13, we went through the detailed forecast sections from the detailed model tab of my Excel forecast spreadsheet. And that brings us to the income statement. At long last, what we've been trying to forecast this whole time is the income statement. So I'll share my desktop right where we left off at the end of part 13, which was just the cost of sales percentages, right? So we arrived at a total Q3 2022 cost of sales forecast percent, 72.7%, leaving a 27.3% total gross margin for the Tesla company in total for all divisions combined. And I think that's going to improve in Q4 to a 30% gross margin, right around somewhere around a 30% gross margin in Q4. And then from that point forward, it'll be better than 30% every quarter and possibly a whole lot better. So that's the end of the cost of sales percent section. What's next? It's the income statement. We're finally here. So what kinds of wacky calculations are happening at the top of my income statement section? There are no wacky calculations at all. Every single one of these is just linking to a section we've seen already above. So these are linking to rows that are in the 500 to 523 to 581 above. You've already seen those rows, but I can double click through these and it'll launch me right up to the top where this is coming from. It's coming from here. So this, here are those rows, and they immediately follow the detail and subtotal by site sections that give us the total revenue. For automotive, cash deliveries, automotive lease deliveries, the total combined, and then energy, services and other, and total revenue. So that's what's going on down here at row 11. Let me scroll back up. Yeah, that's what these are doing. They are just linked to the section above. Well, what about the cost of sales section? Similarly, they are just linked to what's happening above them in the detailed calculation sections. So these are linked up to rows 819 through 872. So if I double click up this, you'll see it's the same kind of idea, that immediately following the cost of sales dollars section, we've got everything totaling up. Automotive cash deliveries cost of sales, leased deliveries cost of sales, total, the energy section, services and other, and then the total totals. All right. So what's happening next? Well, we have wiped out half the income statement already because the most important indicators of how successful your income statement is going to be happen on the top half of the page. Your total sales ought to be increasing over time if your company is growing and you're continuing to grow your earnings. The best way to grow your earnings is to grow your top line revenue. Grow your way to earnings growth. Don't cut your way to earnings growth. This is a rookie mistake that some in corporate strategy make, saying, hey, we got to get our earnings up. Let's cut our expenses. Well, cutting your expenses is a short-term way of getting more earnings because you didn't spend as much money, but a far better sustainable long-term strategy for that corporation's success is to find more people to sell more stuff to. and encourage them to buy more of it and to spend more with your company, the more of that you do, the higher the revenues go. And as long as you're doing a good job managing your costs of sales, your gross margin will improve because you'll be doing more business volume. You'll be pushing more volume through your factories or services, and you ought to be more profitable when you're at higher volume. That's the way economics works. All right. So what those get us to are gross margin percentages in total and gross margin dollars. So we've said, hey, how much total money have we received from people who bought stuff from us during this time period? And then right below that, we record the direct costs associated with giving them what they bought. That's what the revenues and the cost of sales are doing, which gets you to your gross margin. Gross margin is how much money is left after doing that. So after we have given the people what they bought, and after we have taken their money and paid for all the costs associated with delivering their stuff to them, whether that stuff is products or services, we've got gross margin left over. So this is what you need to cover all the rest of your company's expenses with. So what are those expenses? Well, the first one that appears on the income statement for Tesla is research and development expense. So I've got that here. This formula looks a lot more complicated than it is, how I'm forecasting research and development expense for Q3 and Q4 and future quarters. It's just saying there's two components to research and development. There's the stock-based compensation portion, and then there's the everything else portion. And I don't have the stock-based compensation portion only shown on this page. That's way down on rows 1228. Well, I guess it's just all on row 1228. So I can scroll down here and show you what I mean. Here's that row. Stock comp in research and development. So this is just the piece that is in research and development, and over these time periods, these are actuals as Tesla has reported them. I don't think this number is in the quarterly investor earnings release. I think you can only find this in the 10Q or the 10K. So you need to read those documents as well to get insight into that piece of it. So that's not the only area of the company that earns stock-based compensation. The CEO, Elon Musk, earns stock compensation. Other people whose compensation expense is reported as SG&A are recording stock compensation. That's also where Elon's CEO stock comp hits. So the two of those, plus the non-stock compensation SG&A expense, are what total up to the total SG&A expense. We'll get there in a minute. Then there is stock compensation and cost of revenues because everybody who works at Tesla is eligible, after meeting the eligibility requirements, to participate in the stock compensation program. So people who work at the factories have their stock compensation recorded in cost of sales, or cost of revenues is what it shows here. There's row 1228 again. This is how much of the research and development expense is just the stock compensation. And then there's stock comp and restructuring and other that is almost always zero, but I guess you could have hits there if you laid off people who were owed stock compensation. All right, so that's that section. So I'm going to scroll back up and complete my thought on research and development expense, just saying this says, hey, how much research and development expense have we been expensing over the trailing 12 months? And if I throw out the portion of that that was stock-based compensation and only grow what's left that wasn't stock compensation at a 10% rate, which seems about right from a forecasting perspective. This, you can see the actuals jump around quite a bit on this line. And then to that, I just add the piece of stock-based compensation that I'm forecasting for research and development. That's how much there ought to be. So I have a forecast in here of $787 million. And that includes $127 million of stock compensation in research and development. Hopefully that makes sense. All right, the next thing I need to forecast in my model is selling, general, and administrative expenses, and I'm just linking to the section below where I have that totaled up. So I just touched on these briefly earlier. This is the sum of the 3 different kinds of slices we get insight into from Tesla on what makes up SG&A. So it's stock compensation for Elon, stock compensation for everybody else except Elon, whose compensation expense hits in the SG&A area, and then other expense that of having a headquarters with marketing and human resources and all the other areas you would have at a corporate headquarters, right? Okay, so that's where that number is coming from. And then there's not a lot left to forecast on the income statement. So restructuring and other, we had to put some money here. I still have my note in here from how much I thought the Bitcoin impairment was going to be. Everybody got surprised by finding out that it was a lot less, since Tesla had sold most of their Bitcoin early in Q2. All right, so those make up the total operating expenses. And if you take the gross margin and you subtract the total operating expenses from those areas we were just talking about, that leaves you with income from operations, operating income. So here's the operating margin or operating income margin. I've got that jumping to the highest level ever in Q3, 19.9%. Hey, that's a lot better than these years when it was negative or when it was single digits. So Tesla cracked into the double digits a little over a year ago and have not given that up yet. So I'm projecting right at 20% in Q3 and then higher than 20% in all future quarters, with some pretty remarkable growth ahead as Tesla begins to leverage the power of selling the best software in the automotive industry. Full self-driving. Fingers crossed that that continues to make a lot of progress. All right, so what's next? Well, after operating margin, we need to pay the interest to the people who Tesla has borrowed money from. So that's what this is doing. So I'm looking at what the income or loss from operations is, and I'm multiplying that by a multiplier. This is interest income. Sorry, we'll get to interest expense in just a second. So for the interest income, I'm just using as a proxy something that's been working pretty well for me in the past, which is to just apply a multiplier to how much cash Tesla has been generating lately. Tesla's cash balance has been stacking up pretty well. Ideally, you would be basing this off of the average cash balance, but I don't have a forecast for that. I don't forecast the balance sheet, I forecast the income statement. So I just pick something as a proxy that I think will work okay. We'll see how far off $31 million is when Tesla reports it. Here we've got the way that I'm forecasting interest expense. So I'm just looking at, hey, how successful has Tesla been in generating income or loss from operations over the past 3 quarters, and is that number enormous? And if it is, then probably they've been paying off all their debt to this point. So I've got 2 different multipliers here for how much more or less than the prior quarter's interest expense there ought to be. Either it'll be 60% as much or it'll be 86% as much, depending. That's what I've got in here. So the net of these two is almost 0. These are very immaterial to Tesla's total earnings. And then we have other income expense net. So I have humorously applied a multiplier of 0.69 because why not? This, you can see the actuals. If I were to scroll back even farther, you'd see they just jump around all over the place and are very volatile. So it doesn't really matter what you put in here for a number. So that's why I put in 0.69. And then in future years, I've got a little bit of growth applied to that other income number. This is a total black box. We don't know what Tesla's going to report here. So you just forecast something, you move on with your day. The first rule of forecasting is whatever you forecast, it will be wrong. So then we get to a net income or a loss after the provision or benefit for income taxes. Well, I blew right past income taxes, didn't I? You have to pay income tax. That's the law. So in Q2, Tesla paid $205 million worth of income taxes on $2.474 billion worth of income before income taxes. So I'm using that same percentage and applying it to however much income I think Tesla will have in Q3 to say, hey, they've been paying income taxes at this rate, estimated income taxes at this rate. There's no reason for me to suspect that rate is going to change, so I'll just keep using it. And then in this cell, we have a very different kind of thing happening, which is looking at the, well, I've got the sum from D through U over here. So this is the lifetime cumulative net income for Tesla here. And if it's less than 0, then my multiplier is only 11.8%. But if it's more than 0, my multiplier is 25% corporate income tax rate. So the idea there being, hey, you pay a lot less in taxes when you're not, when you don't have retained earnings yet as a corporation, because you've been reporting losses, right? So you've been paying at a lower rate. So if W 1192, if my income number here were a negative number, then I'd be paying only 5% of it. So that's the first rule. And the second rule is, all right, but even if it's positive, but if our retained earnings were still negative, use this lower rate. But if the retained earnings were positive, if we no longer have that accumulated deficit, if we flipped that positive to retained earnings, then paid a 25% rate. And then way here at the end, I've got a plus AU 1194 times 0.8. That's probably not that important. I kid. It's pretty important. So way over here, AU 1194 is doing some math on the deferred tax asset that Tesla has saved up on its books from prior year's losses that they're allowed to roll over and apply against future tax obligations. So what I'm doing with that number is adding the sum of H1192 to L1192, easy for me to say. So H through L 1192. All right, so there's our income or loss before taxes from the beginning of Q1 2019 through Q1 of 2020. That's exciting. Then I'm multiplying that by 0.2984. So these are some calculations I did so long ago, I can't even remember how that math works. But you've got this amount that you've saved up, and it's about $2 billion. And the GAAP rule, from my understanding, is that you can't declare more than 80% of it as a benefit against your income tax in the first year that you claim it. So why is this number so low compared to these numbers? It's because it's taking 80% of that $2 billion as a favorability against all the taxes Tesla ought to owe on making $7.3 billion worth of taxable income, which is a lot more than they'll make in Q3 or have ever made in previous quarters, right? And then next year in Q1 of 2023, I take the other 20% of that amount here, and I'm changing this income statement formula all up because Q1 is the first quarter under the new 2022 Inflation Reduction Act benefits term. So what this is saying is you can't claim more benefits than a 25% reduction of your taxes, which might make you think that the 25 is the portion that that's talking about. But actually the 25 here is the corporate income tax rate assumption that Gary Black uses for what Tesla would normally be paying at for corporate income taxes. And what I'm doing with that is I'm multiplying the 25% by 75% to say, hey, yeah, but that rate is going to be lower by 6.25%. So it'll be 18.75% instead of 25%. Applied to the $9 billion worth of earnings Tesla's going to make in Q1 of 2023 that I'm forecasting. And then to that, I'm going to add the rest of the unclaimed deferred tax asset benefit. So the combined net of all that is to only pay $1.3 billion worth of corporate income taxes. And then in future quarters, there's no more benefit to take. So it's just saying, hey, the rate at which Tesla will be paying taxes on however much it earns from Q2 onward won't be 25%. It'll be 75% of 25%, because they'll be reducing their tax obligation by the maximum allowable under that law, a 25% reduction in taxes owed. Okay, so there's that. And then we have net income or loss attributable to non-controlling interests, which is a fascinating number that is either positive or negative, usually small. So I just say, give me the average of whatever it's been over the trailing 5 quarters, and I'll take that as my estimate going forward. It's probably going to be a small number most quarters, and that's how we get to GAAP net income. And that's the end of the income statement as Tesla reports it, so that will also be the end of this video. So if you've enjoyed part 14 of my Tesla forecast review video series, click the like button, and if you're not subscribed to my channel already, you could subscribe to my channel, and I will see you in the next one.